Historic day for gold today as the yellow metal reaches $2,000, reaching this level for the first time since August 2020. We're speaking today with Lobo Tiggre of the Independent Speculator about the root causes of this rally and where it's going from here. Lobo, welcome back to the show.
Happy to be back with you and our dear Kitco audience on this momentous day for gold and silver, gotta say. Yeah,
momentous day for both these metals. We'll be talking about why they've been rallying. Lobo, let's not ignore the fact that you've been calling for gold and silver to rally for a long time. So yes, you have been right in your predictions, but we're going to be talking about what's been driving this rally. Both sides of the fence. I'm just going to play devil's advocate even before you make your case. I know what you're going to say. The Ukrainian war, or the war in Ukraine rather, has been the dominant factor in driving up safe haven demand. Is this true?
Yes and no. So clearly I did not predict the Ukraine war. And to be perfectly frank with the audience, I was writing the week before that I did not think Putin would invade. I could see him wanting to push back against NATO, all this stuff. Yes. But the consequences of actually trying to conquer Ukraine seemed, dire for all sides. I didn't think he would do it. I was completely wrong, obviously. So what do I know? But I'm just trying to come clean here and say, I wasn't predicting geopolitics to become the driver. Clearly it has. There are people saying, no, Lobo, it's all about the inflation, which is what I have been talking about. And I think that is true. That's the underlying cause. But it is clearly, if you look at the charts, just on a headline day-to-day basis, war heats up, gold goes up, war cools off, gold cools down too. It is clearly the case now that headline news about the war is impacting safe haven assets like gold and silver. But it's a tailwind, David, on the bigger, longer lasting story.
We're going to talk about war's impact on gold, not just this war, but all conflicts in general in just a bit. But I want to touch on the US dollar first. You and I have spoken about this issue several times in the past about the strong relationship or inverse relationship, specifically about with the dollar and gold. Traditionally, these two assets have held an inverse relationship because gold is seen as a hedge to the dollar amongst other things. But these two assets have moved in tandem over the last month. If you look at the DXY, it's been rallying significantly since the beginning of February. Now, Lobo, why is that? Why is it that we're getting two things that are supposed to move in different directions, move in the same direction upwards?
Right. Well, there's a couple pieces to pull apart here. One is that markets are forward-looking. And as we've discussed before, even though gold is priced in dollars currently, and they should have an inverse relationship, right? Gold's an alternative to dollar. It's priced in dollars. If gold goes up in dollars, then dollar goes down compared to gold. But Forex is a different thing. When you say that the dollar is up, well, the dollar isn't up in terms of gold. It is up on the foreign exchange markets. And why is that? Well, it's also a safe haven. So this is not unique to now. I think most of our audience has seen times before when honest to goodness safe haven demand is in the driver's seat, that gold and the dollar go up at the same time.
Yeah.
The audience also probably recalls that it's actually on a longer term basis since 1971. It's not really the dollar that drives gold on a moment-to-moment basis. Markets are forward-looking. So it's the interest rate, the real interest rate, which tells you where the dollar is going to be, or where the markets think, it tells us where the dollar is going to be. That has been more highly correlated than the dollar itself with gold. But it's been over the recent year and a half, we've seen that relationship break down, and we've talked about that too. So gold has been moving more inversely with the dollar over the last year or 18 months. And recently, with fear and really taking over, and you've got both responding to safe haven demand. That is unusual, but not unprecedented. It's in fact normal, I think, in situations like this.
Okay. I know fundamentals are important, but before then, let me just comment on this. In my not so many years of being alive compared to the more experienced guests like yourself, I've learned that the most inconsistent thing that I've observed is the fleeting nature of emotions. So you're right that there is fear in the markets. We can see that in the decline in the equity markets. There is a demand for safe havens, such as the dollar, such as gold. Like I said, emotions are fleeting. The notion of fear could be fleeting as well. When is it that we're going to see a reversal of this feeling of fear and a reversal of the capital flows from gold back out into equities and risk assets, and the dollar by that measure?
Sure. Well, an accurate answer to that depends on knowledge that a mere mortal like me couldn't possibly have, and I'd be very skeptical of anybody who says they do. The path of the war has a lot to do with this. We do have, however, some recent history to draw upon, and that is that if you look at the last time Russia invaded or had a conflict with Ukraine and took Crimea in 2014, we saw gold prices rally 16 or 17% over the course of those months of that conflict. And then when it was over, the Russia de facto had Crimea and the Ukrainians had to just deal with it, and the fighting stopped. That whole extra push to the market rolled over and gold went into reverse. The safe haven demand went away. So I'm not going to tell you, David, that it's next week or
sure.
I certainly don't know when Putin takes Kyiv or fails to. But that war, I think, has to settle down at some point. Either Moscow wins and it settles down with a puppet government there, or a different puppet government, if you like.
Yeah.
Or it turns into an Afghanistan and it settles into a more protracted guerrilla, but it can't remain at a fever pitch forever. And I do think that the safe haven, I'm almost done. I do think that once the headlines start cooling off, once World War III maybe doesn't seem as close to being on the table as it does now, that's when you see this tailwind go into reverse, not the overall market.
All I'm saying is that this positive correlation we're seeing within the dollar and the gold spaces, they're due for eventually a reversal. Either the dollar stays strong and gold falls, or the reverse happens, right? I don't know if this is going to last forever.
I do have to directly address that, I do have an answer to that.
Yeah.
And that is, part of the dollar rally and before the war heated up was because the Fed is going to fight inflation. There's all this hawkish talk from the Fed.
Yes.
Powell is now saying, yes, we're going to raise rates. The balance sheet reduction is going to start and more at a sooner and faster pace than last time. So, that sounds very bullish for the dollar. At the same time, the cause is high inflation, which we've debated this before, but I see as being bullish for gold.
Okay.
So, those trends are not entirely surprising. But so what happens? When gold and the dollar stop moving together? I think the answer is actually something you've heard me say before, and that is when investors and traders realize that the Fed is going to remain behind the curve, that this talk about fighting inflation, it's more talk than action. Yeah, I think they probably will raise 25 basis points next week, but that's nothing compared to 7.5% inflation. So a lot of talk. And at some point, investors and traders realize, hey, you know what? This high inflation isn't going away. The Fed isn't doing much about it. Real rates remain negative. That's bullish for real things like gold, and for the dollar, not so much.
You have mentioned to me in the past when I asked you why gold did not catch up to inflation all of last year. And I asked you, well, when is that going to happen? Is gold no longer an inflation hedge? Remember those conversations? And you've told me every time that gold will catch up when the markets realize that the Fed has been wrong about transitory inflation. The day the markets realize that inflation is here to stay, that's when gold's going to start catching up. Well, listen, gold's been rallying tremendously over the last month. Inflation's at a 40-year high. What are the markets telling us now? Us being speculators, gold investors, participants of the market. What are the markets telling us in terms of inflationary expectations and monetary policy expectations?
It's quite interesting. I wish this Ukraine thing wasn't happening for many reasons, not least of which that I have friends and family in the immediate area.
Yes.
And I'm worried about them. It's a horrible thing, but for our business purposes, the conversations we have and what our audiences want from us, it's this horribly conflating variable. You have the war making all this noise on top of what I see as a previous and longer lasting trend here. To answer your question, I think the day that markets realize the Fed was wrong. Well, the Fed itself has confessed this. Powell said in his testimony in Congress, he admitted to a policy error. Of course, that was nobody's fault. Nobody could have seen it coming. Unprecedented times, COVID-19, yada, yada, yada. But he did say that the Fed should have acted sooner. He admitted the policy error. And guess what? Gold goes over 1900. It didn't get to 2000 without help from the war yet. Mm-hmm. But it was rising. I think that observation was accurate, David. I think people are realizing that the emperor has no clothes. The question now is, does he quickly snatch up a bathrobe and cover himself? Does the Fed get serious about inflation?
Right.
Or does the dollar get thrown under the bus because, the economy is still fragile? And what's really unfortunate about this from an investment perspective is that the Ukraine situation is a wonderful excuse, David. It used to be COVID and the supply chains. Now it's all because of the war in Ukraine. So, we're not wrong. We didn't make mistakes, or we're not, nobody could have seen this coming. And it's a get out of jail free card for the Fed. They can change policy. They can reverse and reverse again. And it's all because of the war. It's not because they made any mistakes.
You know what's really interesting to me, which I like to shed some light on because you know more about these markets than I do, of course. The 10-year yield has been falling on the back of a stronger dollar and on the back of the expectation of higher interest rates this year, several rate hikes depending on who you ask. Because the 10-year yield, the nominal yield has been falling, and because inflation expectations or actual CPI has been high, real interest rates have fallen dramatically over the last month, which I guess partly contributed to gold's rally. But my question is, Lobo, why the decline? We understand inflation. You and I have talked about inflation many, many times. Why the decline in the nominal yield? That part I don't understand.
Well, it's really quite striking. And normally I'm the first to caution not to make too much of the daily noise and volatility. People get all excited.
Yeah.
Oh, gold's down $30. What's wrong? Relax. Look at the bigger picture. But I think actually the daily movements, and specifically for the 10-year, the benchmark rate there are telling. Yes, it's down over the last month, but the movements correspond to the headlines here. So I think what you're seeing is, the days where rates go down, it's when the scariest headlines in it, like the bombing of the nuclear plant in Ukraine, which turns out, the reactors weren't bombed, but boy, was that scary at first. Right. And the bond market responded. So that is, again, the fear trade. That's the same, gut reaction that investors are having. Oh my gosh, I got to fly to safety. That's driving the dollar and gold in bonds up. If people buy bonds, then rates go down. And, before the Ukraine war, we saw some of this. And I remember there was one day where it wasn't the war, but it just, rates went up. Rates went down, which meant that people were buying bonds. And I thought, who the heck is buying bonds in front of the Fed needing to drive rates up? If they're going to drive rates up, that means they're going to be selling, up the wazoo. Who the heck is buying in front of that? So sorry, I'm wrapping up. I'm just saying that the fear factor, for whether it's the war or anything else, can drive people into bonds as a perceived safety, which I think is a false perception. My friend Doug Casey calls it a triple threat to your wealth. I think it's a false perception. But anyway, it is perceived to be a safety zone. And we've seen that on the day-to-day movements. And that's resulted, I think, in part to why this month-long trend looks as big as it is. But in between, when the news goes the other way, you see people getting out, because I think everybody does know that the Fed is going to be selling with both hands as soon as it can. Okay.
I just want to touch on something really interesting. You mentioned the bombing of, well, not exactly the bombing, but the attack on the Ukrainian nuclear plant. If you go on Google Trends and if you just type in the word Chernobyl, that keyword has skyrocketed to more than, well, it was at the index level was at 8 prior to the week of February 13th. Now it's at 100. So relative to current interest, it was at nothing. And now that was my first thought. Are we going to get another Chernobyl? But turns out it wasn't that as dramatic. But yes, you're right. A lot of people are very concerned about the uncertainty in that region, which contributed to a lot of volatility in the markets. Looking ahead now, Lobo, What do you think this Iron Curtain situation that you wrote about in your most recent newsletter is going to mean for the markets at large, and in particular, the gold market?
Sure, I can address that, but I can't resist but just put a word in real quick about the attack near the reactors in Ukraine. That has created uncertainty. I think it's created a buying opportunity for people who have missed the uranium boat so far. Mm-hmm. I think that's just something to put out there. Like there has been no nuclear incident. There was a fear overnight, and the stocks just got slaughtered. Yes. But there has, in fact, not been a nuclear incident. And I don't think either side wants there to be. Ukraine is too close to Russia for them to be cowboy about that, cavalier about so I think both sides will be very careful to avoid doing anything that would actually harm any of these reactors. I could be wrong, but I do see the sell-off as an opportunity. The Iron Curtain, though, this is not a flash in the pan. This isn't something that goes away. I think this is really, really important, and I'm glad you asked about it. The point is, as I wrote about actually the week before, is that the war, as tragic as it is for Ukrainians and people around, it is a regional issue. It's the sanctions, though, that are rocking the global economy. It's not, the bombing in Kiev or whatever. It's cutting 70% of Russia's banks out of the SWIFT system, and suddenly they can't accept payment for X, Y, and Z products. And I don't know if we'll ever know. You've got all these fashion brands from Italy and all kinds of people saying, "Oh, we're not selling to Russia anymore. They're bad guys in Russia, so we're going to do the right thing. We're virtue signaling here that we're moral and ethical businesses." But if their customers couldn't pay them anymore because they're cut off from the Swiss system, are they really being virtuous? Or are they being pragmatic? I don't know the answer to that, David. But the issue, though, is that it's not going away. If Putin wins, those sanctions aren't going away. If he doesn't, and it turns into another Afghanistan on his doorstep, the sanctions aren't going away. I mean, unless some generals have a coup, make Putin disappear and say, "Oh, we're sorry, it was all the crazy man. He's gone now. We're all friends." That's the only scenario I see where the sanctions go away. And if they don't go away, this is a big deal. This is a massive disruption of the global economy. And China's already sided with Russia, not militarily, but they've talked about how rock solid their friendship is. There's a new East-West divide shaping up here, roughly speaking, that has huge economic and investment implications going forward.
Yeah. Not to mention the global perception towards Russia and what that means to the Russian economy going forward, even after the crisis resolves itself eventually, if in fact it does. Just personal anecdote, just to illustrate that point. I was playing a video game. This is a very cavalier example, but just to illustrate the point, I was playing an online video game. I'm not going to name which one, but I just to troll the players on my server, I renamed my username Vlad Putin. I got banned within an hour. My account got banned. Wow. So people are very sensitive about this issue. It's no joking matter. Apparently, even this is a video game, Lobo. But okay.
I understand. And you can say it's a funny example, but it's actually quite telling. It tells you how widespread this is. Here's actually something that I'm not seeing a lot of people talk about, which I think the audience should really take home and think about. Is that okay? China aligns with Russia. Everybody understands that Russia, as important as it is for energy, it's still a relatively small part of the global economy, and we can vilify Russians and cut them off, and the world doesn't end. But if you apply the same sanctions to China, the global economy collapses. I mean, it's not even a recession. If you actually cut China out of the global economy or the rest of the world, that's the end of the global economy. This is financial Armageddon. So the powers that be aren't going to do that. Nobody wants to go that far on either side. But the people, individual human beings out there that are all up in arms and emotionally upset about what's going on, they're taking action into their own hands. Like I'm sure you've seen the news about those ships with Russian oil cargoes that were not able to unload in the UK because the dock workers refused to unload that Russian oil. And then there's even Shell, when they put out their apologetic explanation for why they had to buy this Russian oil to keep their refineries going, they were explaining to their own workers who were upset with them. The workers want to know, why are we buying this oil from evil Russia? And
That's
it's
right.
like, look, we have to have this to keep our plant running. So I'm almost done here, David. The point is, the government people, even the White House is saying, no, we don't want to sanction Russian oil. But the Congress is talking about it because the voters are talking about it. People are calling them and saying, I'm a voter, I'm upset. We need to do more about this evil Russian. And if that spreads around the world, the powers that be could actually lose their grip on this. And you could see a bottom up takeover of markets and push in a direction that the powers that be might not want. This is serious stuff. And you know what? The war ends or whatever, people's feelings don't end. People aren't going to start loving Russia the week after the end of the war.
It's the immediate impact is on the people of Russia and to the people of Europe. Economists are projecting an economic slowdown like we've never seen in Russia since, I guess, the fall of the Berlin Wall. Look at this headline from CNBC yesterday. War fallout, U.S. economy to slow, Europe risks recession, and Russia to suffer double-digit decline. Now, listen, I'm not trying to be political here, but the sanctions are meant to obviously, deter Russia from escalating aggressions toward Ukraine. But it seems to me like the ordinary people are suffering the most. And this is not America here where, all right, we're angry at Biden, we're angry at Trump. Let's vote in somebody new in 3 years or whatever amount of time we have left. No, this is Russia. What are you going to do? Vote in another president? What are the ordinary people going to do about it? They're the ones that are going to, they're the ones that are going to suffer. It just occurs to me that the sanctions are just not hurting the right people.
Well, that's above my pay grade. I don't know how to solve this. I don't know how to do this better. But I think you're absolutely right. And I think, I remember hearing somebody from the administration saying that, they had tried hard to target the sanctions just at the top, just at Putin and his friends and so on. But it wasn't enough. And so, they brought out the nuclear option of the SWIFT thing, and that is impacting everybody. But here's the thing is, I think it's a categorical mistake to think this is just going to make the Russians suffer. Look at the agricultural side of this. Now, I'm not an agricultural expert. I pay attention to the mineable fertilizers because I am a mining guy, but I don't pretend to know everything about soybeans and corn and that sort of thing. But I do know that a lot of farmers use a lot of fertilizers. And I do know that Russia and Belarus are among the top 5 suppliers in the world. So, and the Belarusian supply has already been sanctioned. Belarus Kali has already been sanctioned. So if you take away with sanctions or just by unilateral action on Putin's side, you take away that fertilizer for the world and crop yields around the world get affected. So people are thinking, oh, well, Ukraine is obviously not going to grow as much wheat this year, and that's bad for Ukraine's customers. That's not us. So that's a problem for somebody else. I think that's a mistake. Just look at what COVID-19 shutdowns taught us about how interdependent the global economy has gotten. You take out 2 of the top 5 fertilizer producers in the world, that has to have a substantial impact. Think about it. Part of my theme here, this whole Iron Curtain thing, and why I think it's lasting is because I see a paradigm shift happening here. It's a very unfortunate one. It's the opposite of Gorbachev saying, you know what, it's time to end the Iron Curtain. We need to participate in the global economy. We have the world making a decision to go in the opposite direction. But let's not just cry at our beers. The clear investment implication. I don't know how all this plays out when, what the moment by moment blows are. But the implications are, David, the clear implications are a less efficient global economy. I mean, being less dependent on foreigners means duplicating infrastructure. It means we all have our own fertilizer mines, or we all make our own chips. So we, forget division of labor internationally. So costs go up, efficiency goes down, raw materials get consumed in greater amounts. This is actually bullish for commodities, even if it's recessionary, which brings back the stagflation scenario I've been talking about. Now, I wish it wasn't happening for this reason, but my wishes don't count here. I'm not God. My wishes don't rule the world. All I can do is sit here and look at what's happening and saying, I hate it, but I can see investment implications as a metals and mining guy, as a commodity speculator.
Okay.
I see trends here that are investable.
All right, let's sum up here and we'll wrap up on these trends, focusing on gold because today the theme of our discussion is gold reaching $2,000, the critical threshold. So where can we go from here is my question, given your macro outlook, given your inflationary outlook, given your stagflation scenario that is looking more and more likely to play out. What's gold's next target for you this year?
Well, people are going to hate me for saying this, but the honest truth is my next target is probably downwards, near-term downwards. I'm not a military expert. I suspect that the hot fighting in Ukraine can't last much longer. And when that cools off, the fear fades and gold's recent tailwind turns into a headwind. That does not change or derail the bigger trend that you just talked about at all. So near term, I think as the war cools off one way or the other, Ukraine knuckles under or the fighting stops, it turns into partisan fighting, whatever. It's probable but I can't put a number on it. I think there's a very real risk to the downside in the near term from the end of the war, one way or the other. Beyond that, we revert to trend. Mm-hmm. And the trend was already headed up towards 1900 and heading higher. So you already called me out in January. You had me making wild predictions for me. So I will stay the course there. I do think that the inflationary trends, the stagflationary trends still call for, plus 2,000 gold by the end of the year, plus 2,100 is easy. If we were to hit an inflation adjusted high, it's plus 2,800. And that actually would not be hard to reach by the end of this year at all. That's not a prediction. It's a possibility. Right.
Well, just to be clear, you were calling for higher gold when I pinned you against the wall earlier in the year. Again, you didn't predict this war in Eastern Europe, but your trend predictions have been correct so far. So congratulations on that. We'll look forward to having you on next time to update the viewers on the gold and silver markets. We didn't have a chance to talk about silver, but like you mentioned, silver moved up dramatically as well. We'll save that for another conversation. Let's not give away everything in one go. All right. We'll talk to you next time, Lobo.
Thank you, David. And good luck to all you investors out there. Interesting times.
Interesting times indeed. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more. And don't forget to subscribe to our YouTube channel.